Hey everybody, happy Monday and welcome to our second in the June Advisor Mastermind series. My name is David Jewell, Director of Operations, and we're going to have three of us today. We're going to have me, Scott Rader, and Robert Rayburn all talk as well. Kind of as a brief introduction, since there is three of us, all three of us are going to go pretty quickly. We're going to go over a lot of content very quickly. This is kind of just to give you guys a little snippet of what's going on in different phases. And then you guys can come and ask us questions on the side, either shoot us email. You can definitely put questions into in the chat bot here, but feel free to email us or call us if you have questions on any of these items that we're going to go through today. So for our agenda, I'm going to start us off and I'm going to go over how we kind of have a new thing that we've been working on for a long time. We're going to be calculating your client's current risk score. And kind of the neat thing behind this is we're going to be including the IULs and the annuities that the clients have in there, which is something that's a little bit unique. Then we're going to have Scott go over into some of the compliance highlights that we've had in the first half of 2024. He's sent a few of these items around over the last couple months, but just some of the items that have been kind of on our radar lately. And then Rob's going to go over some of the conversations to go over with clients around the election. We've been getting a lot of questions around that the last few months, and there's a lot of clients that are fearful. So I'm even excited to hear what Rob's got to say about that. So I'll kick us off here, as I said. So this is kind of a add-on to what Rob kind of talked about last month. So kind of the step one to all of this, and this is kind of the work in progress portion of all of this, is we are going to get a client's risk score. Rob talked about last month the risk-based strategies that we have, and we've sent around a few emails on some of the new questions that we have around a new risk assessment. And we have 4 or 5 ways now that you can get this risk assessment filled out by your clients. We have it in the wealth assessment. We have these questions. We have a one-page PDF that these questions can be filled out. And now we actually have somewhere on lifepro.com where you could send a link to your clients and they can fill this out as well. That's kind of the beginning gauge so that we can get a client risk score and compare it to what they're actually in. And again, as Rob said last month, we do all of the work after we get these questions asked. So we go in and actually calculate this risk score. This is the way that I filled it out, and my risk score is a 64. We are acknowledging if there's a few other websites and risk score calculations that are out of 100. We'll use those as well. Obviously, eventually we would like to get everything standardized and get them all on this, but we will use those as well, especially if you have them from past relationships with the clients. And then, as you guys probably know from the past wealth assessments, we were just asking them if they were conservative, moderate, or aggressive. Currently, if we don't have anything, we're using that. So a moderate score would just be at 66 right now until we can get an updated score from these questions. So this is kind of the work in progress portion. And I'll show you later where you can go on My Life Pro and look at a lot of this information. So the step two is to calculate the client current risk score. And we're going to get into not too much math here, but a little bit. So the first thing we do is we take each LPAM account as well as each IUL and annuity that we have account values for, and we get a risk score. So the way that works is for all of the accounts that are in one of the LPAM strategies, we run those, the positions that are currently in those strategies into that same VAR system. So the same way we're calculating what their risk score is, we're taking those positions and getting a similar VAR risk score. So we're going to update those quarterly, and that's how we get all of the scores for all the LPAM strategies. For all of the other accounts, we get a risk score by looking at the rolling 365 standard deviation of that account, and then we compare the standard deviations of those accounts to those LPAM accounts that we already have the VAR risk score for. So if they account has a standard deviation of 20, and that's what the risk score is of tactical opportunity, for example, it would get the same risk score as tactical opportunity. If it was 15, then it would be a less number, and there's a calculation that goes behind that. And if you have more questions about the details of those calculations, we can go into those as well. But that's how we're getting them for those third-party accounts and the accounts like those. So the IULs get a risk score of 30 and fixed indexed annuities get a risk score of 10. Again, we use those for the calculations and it uses all of those accounts and gets one number for the entire household. One thing to note here is if there's an IUL or an annuity where we don't have an up-to-date account value, currently it won't use it in the calculations. So the carriers where we do get a monthly update is currently Allianz Life and Allianz Annuity. We do get updates for LSW Life. If there is an account that is with, let's say, American Equity, we can get an account value and you can send that over to us and we can enter that into the system and then it will do the calculation. But since there is varying levels of those account values, currently it wouldn't be added in there. And we do have a solution for that as well, which I'll show you guys in a few minutes. So here's just a quick example of that. So what we get, we have a score for each account now. So now we could take the weighted average of each of the account values and get the household risk score. So here's just a real simple example. If we have a $100,000 account with a 90 risk score and a $200,000 account with a 60 risk score, obviously the $100,000 account is 33% of the household value and the 200,000 is 66%. So we weight those, and then this client would be a 70 risk score for his assets, or his or her assets. So the step 3 is do the risk scores match? And this is where we're still learning because we kind of just started to get these numbers a few weeks ago. So we're going to analyze if the risk scores are within 10 percentage points. Currently, that is a complete arbitrary number, that 10%. We're still analyzing how far off is potentially too far off, and you guys can help with that as well. So we're going to continue to look at it household by household and just see if potentially any updates need to be made. Now, if they don't match, and there will be scenarios like this, if they don't match, we can actually put in a risk tolerance note, and this note can be saved. A perfect example of this is my parents. So my parents have money with Life Pro Asset Management, and they're kind of a moderate risk. However, the money they have with Life Pro Asset Management came in a sale, and it's not needed for them in retirement. So they are able to be a little bit more risky with that money. So that would be a note that would go on. So if there was a client that they were conservative, but they were in a more risky profile, we would want to get some type of note so we know the reasonings for that. So this is a screenshot. All of the advisors, I've actually added these numbers. Any numbers that we do have are in my Life Pro. So again, these are the 2 households that I have. We have me and we have my parents. My risk tolerance is a 64. And my current risk with my small LPAM account and my Allianz IUL that I have has me at a 66. So I'm actually looking pretty good. Same with my parents. I said you might need that that note in there, but their risk tolerance is actually a 66, and they have an annuity and they have funds with LPAM, including an enhanced income. And overall, the weights there is a 66 as well. So feel free to go in and check those out. See where you might need some risk tolerances, see some current risks. If you have any questions, definitely let us know on that. And if you have any questions overall, sorry, feel free to contact me. It's djulian@lifepro.com. And it's a good thing that I'm going to kick it over to Scott Rader because apparently I can't talk anymore. So thank you all very much.
Good afternoon, everyone. Yep, just sharing my screen here. So hope you feel better there, Dave. You should go dying on us.
Thank you.
Yeah, so uh, basically, just want to kind of kick off on some compliance highlights, some things that have been top of mind for us the first half of the year here. The new fiduciary rule, of course, the 8424. We'll talk a little bit about that. Don't want anyone to worry too much about it because we've got a long runway for that one. I'm sure there'll be many iterations of it before it actually becomes effective. I mean, it is effective, but we'll see when it actually lands. The new continuing education requirements for IARs, a brief little overview of that, very brief. Some annual reviews, super important. I get a lot of questions about them, so I thought I'd touch on them. And then the new super hot button issue for regulators, which is off-channel communications. And I'm sure you might have seen my email that came out about my rep chat. So we'll dive into that just briefly, but without further ado, the new fiduciary rule. So 8424 came out. They are basically the Department of Labor is replacing the 5-part test, which was this has really been focused on insurance. 2202, which for IARs, I think you guys are aware of the DOL form, that's not changing. But for if you were doing insurance and annuities, I guess annuities, I should say, that's looks to be changing right now. You used to be able to find a safe harbor with the 5-part test because you didn't meet the full 5-part test, and so it was like one-time advice. Well, they've gotten rid of that and they're painting with a broad brush. Any advice you give to a retirement investor, so if you're giving a recommendation to an investor holding an IRA or 401k, et cetera, 403b, you are considered a fiduciary. So therefore, you have to find a exemption in order to get paid for that. And so what I think this will turn out to be is probably a disclosure form. That's usually what happens. A disclosure form with basically the how much commission, some other disclosure language in there. We'll see where it lands. But that's what the DOL is doing right now. We've seen so many iterations of the DOL from, what was it, 2014 or something like that, all the way to now where it's come out, it's been repealed and so on and so forth. What I think everyone needs to keep in mind is that it's 5 months until this is actually effective. There's 5 months until the effective date of this. And then there's another year to be fully in compliance. And in that year, we have an election. So Robert's going to talk about that. But I imagine the results of that election will have a big impact on where this DOL lands. But just know that we are paying attention to it. We are out there making sure we do the research, and we will be ready to be in compliance when and if if this passes and what we will need to do. So I just wanted to touch on that briefly. Another item that came this year is the new advisor CE. So I want to remind everyone that now, as an IAR, you are required to do 12 credits of continuing education to maintain your IAR registration in your state or in states. So those 12 credits include products and practices, and then so 6 credits on products and practices, and then 6 credits on ethics and professional responsibility courses. So you can do that through many different sites. I recommend doing it through WebCE, but if you're already doing it, if you happen to be doing your insurance CEs with whoever you do it with, Reg Ed, WebCE, there's lots of places to do that. You can do it most likely in any one of those sites too. You'll have to just register for combination of courses or 1 or 2 courses, just depending on what the course credits offer you. If they're 2 credits each, you might have to do 3 of them. If one of them's 4, it just depends. Any questions, you can let me know. But you'll just make sure you do it before the end of the year. And this is going to be for all states at this point. So California, a lot of our advisors are all part of that. So are all registered in California. So therefore you're going to have to do it. But this next slide, you can see every state by 2024 has basically adopted it. Some have already adopted it before that. I know I've had advisors already do the CE requirements. And then, the U.S. Virgin Islands, I don't think we have anyone registered there, but, they're going to adopt it in 2025. But by, this year, every state's basically adopted this requirement. So just a reminder, if you guys have any questions, please feel free to reach out to me. I'm happy to help you as best I can. And
Scott, quick
now, so,
question on
oh,
that. So we had a question, do insurance and or CFP CE credits double for the requirements on that?
it's going to depend. It depends on what the class is. I have to probably reach out to the state and ask. There's also a way to look on um, the like FINRA site, because FINRA tracks all this stuff to see if you've met the education requirements. So after they get it and they get credit, I can always pop in there. You can do it on FinPro themselves, but I can help look it up and see if it doubles. Since this is brand new, I'm not 100% sure.
Got it. And then I actually had a meeting this morning with Orion, and they said they had some potential CE credit courses in there. And they were saying that they were actually no cost. So we need to look into that more, but
Absolutely.
just something potential to be on the lookout if that is something that our advisors would be able to use.
Absolutely. As long as they take it, it really doesn't matter where you get it from, as long as it meets the requirements and they finish this before the end. So yeah, absolutely. So yeah, so annual reviews. This is something I get a lot of questions about. And I just think it's so important for so many reasons. So it's a crucial part of services that you provide clients. And basically it allows you to assess client goals. Like the annual reviews, they allow advisors to evaluate changes in client goals, the changes in their financial situation, risk tolerance, and ensures that the investment objectives remain aligned with clients' objectives. You can monitor performance. I mean, that's a big part of course, being an IAR and for clients is monitoring the performance of their accounts. This is Robert always talks about being a coach. It really allows you to be a coach. So if the performance isn't good, just really having that open dialogue with them to remind them to either, maybe they need to stay the course based on their age. There's always going to be facts and circumstances, but these regular reviews enable you as the advisor to assess the performance. Is it meeting clients' objectives? Does it help you identify the successful strategies or areas that may need adjustment? If you do need to adjust the strategy, you can review the client portfolios and then make those necessary adjustments based on market conditions, economic trends, changes in the client circumstances. Of course, clients may inherit money, may have some outlay of money coming out. There's always things changing with clients, so it allows you to kind of stay in tune with the client. I think most importantly, it just reaffirms trust, right? When you do annual reviews with clients, it shows that commitment to client satisfaction and the transparency. It provides you an opportunity to address any concerns or questions that clients may have, and it really just reaffirms that advisor-client relationship, and that's super important. Of course, the last one, it is your fiduciary responsibility to meet with your client at least once a year. But again, I think if you are meeting with your clients and you are, reviewing the portfolio constantly, it's not only is it gonna, just strengthen that relationship, but it's also, clients, we know they say one thing, they may not really mean that, and you really get that by having these meetings. You know what I mean? They may say they want all the returns in the world, and as you're working with them, you realize they can't take the swings when they want, high returns, because you have to, obviously take more risk. So it allows you to really kind of understand how they feel, coach them through it, and then make adjustments if needed. You know what I mean? You might need to adjust to, hey, look, you say you want these returns, but you seem to always have these battles with your conscience or whatnot when things aren't going exactly how you want them to go because of the market. So maybe we need to lower the risk on that. You know what I mean? And it's always going to be harder for a client to take action against you or complain when you're having these regular meetings because you have your finger on the pulse of the relationship. Um, oh, I don't know. I don't know what's all they're changing. And then just these are some key components of the annual review. There are a lot of them here. An annual review doesn't have to be this thorough, but it just wanted to address some of the things that can be part of the annual review. Reviewing the client profile, reviewing their personal financial profile, including any changes in the client's circumstances. Again, they might get a new job, something might happen with their family, they might have new financial goals that you may not have been aware of from the last time you met. So it just gives you a chance to do that. Evaluate the investment performance, make changes as needed, evaluate their objectives and risk tolerances. Talk about, check with their goals, make adjustments based on, again, circumstances that happen in their lives as the relationship kind of goes over the years. Risk tolerance review, I think this is important because maybe you haven't really dove into that in a few years or something like that. So it's always good, I think, every year to just do a quick risk tolerance review. making sure that everything in the portfolio is in line with what their risk tolerance truly is. And also, again, we have that one-page risk tolerance questionnaire that Dave talked about. It may be something you want to give them. And again, just because you get that risk number, there could be a conversation, because sometimes that's not going to tell the whole story. There could be other things that they might want. This may be money that they want to play with. This may be money that it is all the money they have. So again, it's not just because you get that risk number doesn't mean we can't put notes in there and adjust it as necessary, but it is something that at least give you a talking point, a starting point. Again, portfolio rebalancing, financial planning updates. If going over their entire financial plan, if it's you're doing the insurance and you're doing the investments and all the other stuff, college planning, things like that, just giving a chance to go over all that. Again, education and communication, educating them on market trends, communication, reaffirming that strong relationship. You can review the expenses and fees of the accounts, reviewing, reminding clients what they pay, things like that, so they don't feel like they're paying, like they never heard of their advisory fee before. Of course, documenting this for compliance and for yourself as well. And then any follow-up and action plan. So if there needs to be another meeting, or if you need to do some adjustments, you can always follow up with them, create an action plan going forward if there is changes. And just helps you document and again, really strengthen that relationship with the client. The last slide on this is just where can you keep these annual reviews? I think it's really important that we use some sort of CRM. If you take notes in a notepad or something like that, that's great. But you want to put them somewhere where they can be searchable, they're contemporaneous when you did it. And so it just shows that evidence. If you ever, down the road, you need to pull them. So we have lifepro.com where we have an annual review form. You can use Redtail, which is free. We offer it to you, another great tool to use for annual reviews. And then finally, you can also do email recaps. They're going to have the date in there. You can say, it's a pleasure meeting with you, et cetera, and then just do a brief recap of the meeting. Again, just hitting the highlights. You can also do that even if you put it in Redtail. You can also do email the client so that they kind of know that, again, their follow-up action plan. So off-channel communication. So coming to the end of this presentation, just wanted to touch on this. So as a reminder to everyone, the approved methods to communicate with clients right now regarding business and any kind of business or securities business is your approved business email, any approved and disclosed social media accounts, and now we've also introduced My Rep Chat. There's been so many fines to firms as it relates to like text messaging clients, using all the WhatsApps and the Signals and Telegraph. There's lots of these new chat apps out there. Regulators are aware of them. And so just with all the technology, there's no more way we can't as a firm tell people, we just prohibit this stuff. They know it's out there. So, and they know, especially text messaging is kind of like the way we all communicate these days. So we had to have a solution for that. And so we went ahead and we're using My Rep Chat, which I think is it's inexpensive, it's straightforward, it's simple to use. It's easy for advisors to install. And so we have some videos, we have some literature on it if you want to research it more, if you're interested in it. But basically some highlights of it. It allows advisors to use one number. It kind of works like a WhatsApp. You download the program onto your phone, you text from that app, but it will come from your phone, whatever phone you put in there. Usually you want to use like a landline. If you have like a landline and office line, it'll come from your office line, and then clients can text back that office line. It's going to go right to that app. So you'll be able to read everything in there, but it allows you to have just one number. You have the text and group chatting. It has a scheduling function, a digital assistant. So you can actually use your CRM, lock it in there. And if you want to send out automatic like birthdays, like you might have from like your dentist or doctor where they send you like happy birthday. So you can do all that stuff. It kind of acts like that as well, making it a little bit more personable. You can import your contacts, and then also if you don't have a landline, you can ask us. They'll give you a phone number, and then if any client calls that phone number, you can make sure it will automatically forward it to the phone number you want. So if you only use your cell phone, it'll forward the call to your phone number, but they're still calling that phone. So it's kind of slick like that. Again, we have lots of literature. I don't want to spend too much time on it, but happy to talk to you guys offline. Lastly, we are going to start instituting a new quarterly certification for approved electronic business communications that will come out via CompliSci, as I just sent out your compliance manual and whatnot via CompliSci. So there's a certification for that. So just another certification, of course, just making sure everyone is aware of the new rules. And if you have any questions, I'm happy to address them. But thank you guys so much for your time.
Thanks, Scott.
Yeah,
Yep, perfect. I'm just gonna go ahead and share my screen here, and
I gotta stop sharing. Hold on there. It's
while Scott figures out the unshare button,
yeah,
it's a lot of good information there. And I think one of the big themes that David and Scott both touched on was this idea of the annual reviews. It's something we talk about a lot with advisors directly. It's something that we talk about with clients. And I think Scott and Dave are probably letting everyone off the hook a little bit easy in the sense of calling it an annual review. I definitely encourage advisors to have multiple conversations per year with their clients. It's one of the best sales techniques, one of the best retention techniques as it relates to your client relationships. The best way to understand where your client is by talking to them. And not every conversation needs to be a formal annual review. It might be just a catch-up session. Hey, see where things are at, what's new in their life, how was the last quarter, how's their family doing? All of these things are non-quantitative factors that ultimately do impact how a client looks at their investments, looks at their annuities and their life insurance and their overall asset allocation mix. So definitely encourage multiple conversations. When we look at our new business and a lot of those point of sale calls that we do have with advisors, one of the best selling points we use to win new business is to ask the simple question, when is the last time you heard from your advisor? And probably 8 times out of 10 or so, the answer we get is, I don't even remember the last time I heard from my advisor. So don't ever be in that situation. Clients want to hear from you. There's a reason why they engage with you at the very beginning. So, it's all part of that reselling process that we engage with clients on every single day and every single week and month. So one of the things that I wanted to go on here was about the upcoming presidential election. And of course, now part of this will be, we're going to be offering our official endorsement for president. No, I'm just kidding, of course. But what we did want to do is address that question of how is the presidential election impacting conversations between advisors and clients? Because we know that it's a huge topic right now. It's a huge topic of distraction. In other words, it's a threat that is definitely distracting clients from their long-term plans. There's a lot of emotion tied with it. And answering those questions and answering those concerns can be equally as challenging, because you want to empathize with the client's concerns, but at the same time, you want to provide real advice, right? You want to make sure that clients are not shooting themselves in the foot by letting their emotions take over. And certainly this election is one of the more emotional ones that we've seen in recent memory. But I feel like we say that about every presidential election that we go through in recent history. So real quick here, 2 things that we're going to go through today. Again, guiding clients through those presidential election concerns, and then some of the investment themes that we're focused on throughout the summer months here. And that's just not on the equity side, but also on the fixed income side as well. So when we think of the presidential election and the fears around that, 2016 was a big year for that. Obviously when Hillary Clinton ran against Donald Trump, and then again in 2020, we had Trump versus Biden. And with that, we had the post-COVID period. So you had all of these emotions that sort of came into play at one time. And now, of course, we have 2024. Our conversation every single time is the same thing, which is the government in general is going to do everything it can to goose the economy ahead of an election. And that tends to be market positive, regardless of which side of the aisle you're on. And I wanted to point toward this chart here on the right, which is the S&P 500 total return in election years. And you can see here, if you go through every single year, going all the way back to 1940, there's only 2 years where you've had some negative returns. And this is when the incumbent is running again. And so you had 1940, which is pretty plausible with World War II, and 1932, which was the Great Depression. Other than that, you really haven't seen a whole lot of impact from the presidential election as it relates to heightened risk to market returns. What are some of the big fears that we're hearing from advisors and clients? Well, there's going to be civil and economic chaos before and after the election. COVID was a big time period for concerns around that. And guess what? The country survived and moved on. It thrived afterward. We look at the stock market declining, due to one other side winning. That's another big topic we get. So when we're on the phone with clients that tend to be left of center, their fear is obviously that Donald Trump wins. And we have conversations with clients right of center. Well, the fear is that Biden gets reelected. Again, one of the great things about the US, and you see it with S&P 500 returns throughout time, is that we have split government, right? So power is not concentrated in any one body, whether it's Congress or the White House or the Supreme Court. It all dilutes itself, and it actually makes it very hard to pass legislation in the US versus a lot of the other systems of government that we see, whether it's in Canada or across the European Union, the UK, Japan, etc. Those parliamentary systems, once a party gets a majority, they can pass real life-changing legislation in a matter of 90 days. You don't have that in the US. In the US, it's very, very difficult. It took Obama almost a full term to pass healthcare reform. And that was pretty much all he was able to do. So, again, it's a very dilutive process in the US. It's meant to make sure that neither party can pass extreme legislation. And we don't think that the results of this election are going to mark any changes to those rules. When we look at the polls right now, obviously presidential election looks 50-50. When we look at Congress, it looks likely the Republicans retain some form of power in the House of Representatives. And then the Senate's a little bit of a toss-up, right? Right now, it does look like the Democrats may retain a seat or two. But again, looks like split government is the most likely result of the 2024 election. And again, what's that mean? No, it sort of leads to a do-nothing government, which markets tend to like. There's a common phrase on Wall Street that the only thing the government knows how to do is screw things up. So if you have a do-nothing government, that tends to be market positive. The other thing that we do see is the election is different than all others. And there was a great book that came out a few years ago. It's called This Time is Different. And the concept of that is that it really isn't different. And we'll go through why it's really not that different. And that can be in conversation that you have with clients as well. Now, other thing, of course, is, the myth number 2 is to sell ahead of the election. So here what we did is we went through the presidential cycle from the first year that a president's in power and the historic returns that we see there. And then the midterms, year 3, and then, of course, the election year, which is year 4. You'll notice the second best year. And again, I'm not a huge fan of these cycles because there's a lot of other factors that come into driving market returns. But if you assumed and isolated one factor, which is the presidential election, and you said that was the only factor driving returns, you'll see the presidential election year is actually the second best year of the 4-year cycle. So we just don't see it in history. We don't see it in the numbers where presidential election cycles lead to protracted periods of bear market returns or declining returns in the market. If we were to break up the historical election year, so every time you have a presidential election, every year you have that, and you look at the historical returns from January 1st through to the end of the year, what you'll see here on the chart on the right is that the most uncertain period you have during a presidential election year is actually Q1, where a lot of people are just repositioning portfolios ahead of the election. And then guess what happens? The market historically tends to grind up into the news, right? You have a little bit of uncertainty right here when you're about a month away from the election. And then you sort of get a buy the news event, right? It doesn't matter who wins, the markets rally. And that's common on Wall Street. It's sort of, sell the rumor, buy the news, buy the rumor, sell the news. And at the end of the day, the economy is always bigger than the government. The economy is always bigger than any particular candidate that's running for election. That's what makes the US economy so resilient, so durable through time, is that the amount of innovation that we see taking place in the private sector far outweighs the impact of what you see happening in Washington, DC. Of course, myth number 3 is that this time is different. And, I kind of went through, I typed in Google, this is the most important election of our lives. And almost every election in my life has been defined as this is the most important election of our lives. And I think it is important to provide some context of where we are today and the nervousness around this election versus where we have been as a country in the past. And, for a lot of younger people who think that these are challenging times, it's important to look at history and look at in 1860 and 1864, we had 2 presidential elections during a civil war, right? No war has killed more Americans than the war we fought with ourselves during the Civil War. 1916, we had the First World War. 1932, 1936, we went through the Great Depression, which had 20% plus unemployment for a very prolonged period of time, and where we really did see a massive decline in the standard of living across the US. 1940, 1944, World War II, war with the Nazis. Again, these are events that, in my opinion at least, far outweigh some of the challenges that we're seeing today. And then you talk about the Kennedy assassination, the Vietnam War, the global financial crisis in 2008. Most of us were working during that time period. We weren't even sure if the banks were going to survive, and not the regional banks, but the Bank of Americas, the Citigroups. There was a real concern that we were going to revisit the 30s. And so we've been through worse is sort of the message there. And each time the private sector in the US finds a way around that, and innovation continues. And I think that's part of the reason why you see when we look at stock market values in the US versus the rest of the world, why we see such a distortion in favor of the US, just because of that level of innovation. Now, in terms of summer themes, how are we navigating the market going into the summer and ahead of the election? Despite my comment about the US market and the level of innovation, there are certain pockets within the US equity market right now that are very, very aggressively valued. So when we look at tech valuations right now, certainly a lot of those valuations are as aggressive as we've seen since the dot-com bubble. We look at pockets of tech, like such as AI. There's a lot of blue sky valuation that's built in for the next 10 to 15 years. A lot of these companies are probably not going to live up to the hype. Some will. And that reminds me a lot of the internet in 2000, right? Like the internet was right. It was the right place to be. But that didn't mean that companies like Amazon didn't go down 85, 90% and then proceed to go on to sort of the more durable rally over the next 2 decades. The message here is you don't need to chase. This is what we say to a lot of clients. If you didn't own NVIDIA in the last 2 years, don't chase it just so that you can be part of the party, because a lot of times that ends up leading to you being the last person that attended the party. Theme number 2 here is emerging markets in Europe, in our opinion, represent generational bargains. So when we look at the MSCI EAFE, which is your developed world equity markets that are outside of the US, those MSCI EAFE returns since 2007 are around minus 5%. During the same period, the S&P 500 is up over 200%. that just kind of gives you an idea of that distortion between the level of innovation and the level of revaluation we've seen in the US versus Europe, Japan, and Canada. In the emerging markets, it's even been more pronounced, where the MSCI Emerging Markets Index is down about 20% or so, versus the US, again, which is up north of 200% over that time period. As interest rates stay high in the US, as growth starts to slow down a little bit in the US, we are starting to see the first signs that investors are looking overseas at some of these bargains and saying, you know what? There are some Facebook-like companies. There are companies like Amazon that don't do business in the US that are trading at 9, 10, 11 times earnings. That's not bad compared to buying a company here in the US at 40, 50, or 60 times earnings. So there's a lot of bargains overseas as more and more people look at rising rates here in the US. There is this thought process of, hey, you know what? There's opportunities overseas. The third big theme here, interest rates. In our opinion, this is providing an incredible moment for investors and retirees to lock in attractive streams of income. Now, this is a theme that we talk about a lot, and it's not just in the in the bond markets, but to some degree, the equity markets. We certainly see some equities that have better dividend yields associated with them. But in particular, it's the bond market and the annuity market. So when you're looking at retirement right now and you're saying, hey, I need a certain stream of income to rely on that is not going to be subject to the unknown variations of stock market price movements. And, I don't necessarily want to have 0% returns like we've seen in the bond market in the past. Right now you can build a fairly low risk portfolio and generates, anywhere from 5 to 7% income yields. An annuity market, same thing, right? Where we see interest rates on the rise, and that makes annuities that much more attractive. So we are definitely saying to people, we have no idea whether this is the top of the cycle for rates or the bottom. I mean, certainly not the bottom of the cycle, but we don't know where rates are going to go necessarily. No need to make a call. If you think that you can protect your lifestyle by generating predictable income, and with these rates that are on offer today, 25-year highs, probably not a bad option to at least consider de-risking your portfolio a little bit and locking in some of these rates. So that's a big theme within the bond market. We're definitely looking at high duration versus short duration. For many years, we had been on the side of short duration because we have an inverted bond curve. What an inverted bond curve means is that interest rates are higher for short-term bonds than they are for long-term bonds. Now, that remains the case, but what we are starting to see is that growth is starting to slow in the US. And when that happens, your long-term rates start to decline a little bit. And if you own a bond and rates go down, the price of those bonds go up. So we like the idea of high duration for two reasons. Short-term, if growth is softening in the US, that's actually good for high duration bond performance. But number two, if rates are starting to come down, and that's a big if, but if they are starting to come down, why not lock that in for a long period of time? So if you have a portfolio with an average duration of 10 years versus portfolio B that has a duration of, say, 4 years, that means, in a very simplistic way, that you have those rates in effect for 10 years versus 4 years. And if you like that, and that's going to provide income security and lifestyle security, let's go high duration, even if that means absorbing a little bit more price volatility on the bond side. So that's really been our focus on the fixed income side of things. So in summary, the presidential election definitely elicits a lot of emotion, but our message is the stock market historically doesn't really care. And we even see that with whether you have a Democrat in power or a Republican in power. When we look at the 1990s, the Clinton administration, and you had a Clinton administration, but a Republican House, and you had a record bull market stretch. In the 2000s, you had a good bull market until the financial crisis, and you had a Republican administration Obama, same thing. Trump, same thing. So again, the stock market is not an ideologue, is the big message there. In fact, and as a chart we did not include, is that one of the stretches with best performance is when you have split government. And that's what the market likes. The market doesn't like one party being too activist. Doesn't matter if it's right wing or left wing. Number two, markets outside the US are very attractively priced in our opinion, while many parts of the US do look fairly pricey here. And then lastly, using interest rates. Interest rates are attractive, close to 25-year highs, providing savers a historic moment to lock in streams of what we consider very low risk income. So that's what I got for our advisors this month. Feel free to give me a call, give Dave or Scott a call. We're here to help, whether that's on the marketing or sales front or answering questions for clients. Just let us know. We're here to help your business. But outside of that, that's all I got, guys.
Yep. Thank you guys all very much. Have a good day.
All right, take care, and we'll speak again next month.